All right, ticker shockers. What if I told you a tech giant just reported earnings, slightly missed analyst expectations, and then boom, its stock surged over 20% in after-hours trading? Sounds like financial wizardry, right? Well, today we're unmasking the magic behind Oracle's latest shocker. So here's the scoop. Oracle, ticker ORCL, just dropped its earnings report, and on the surface, it looked a bit mixed. Revenue came in at $14.9 billion, and non-GAAP EPS was 1.47, both slightly missed analyst estimates. Usually, that's a recipe for a stock slump, but not this time. Oracle stock went absolutely parabolic, rocketing over 20% after hours. Why? Because investors looked past the slight miss and saw something truly astonishing. Oracle's remaining performance obligations, or RPO, exploded by a mind-blowing 359% year-over-year, hitting $455 billion. This isn't just a number, folks. It's a massive backlog of future revenue, especially in their Oracle Cloud Infrastructure, or OCI, thanks to multi-billion-dollar deals with AI titans like OpenAI, xAI, Meta, NVIDIA, and AMD. This signals one big, unprecedented demand and a massive runway for growth. Now for the uninitiated, who is Oracle? They're a global tech behemoth founded way back in '77, headquartered in Austin, Texas. At its core, Oracle provides products and services for enterprise IT environments. Think big business software, Fusion Cloud ERP, HCM, supply chain management, and a suite of applications for every major industry. But what's really driving them now is their cloud and license business. This is where you find their powerhouse Oracle database, Java, and critically, Oracle Cloud Infrastructure. That's their answer to Amazon Web Services or Microsoft Azure. In fiscal year 2025, their total revenue hit $57.4 billion, a solid 8.38% jump from the previous year. Looking ahead, their EPS is forecasted to surge by nearly 60%, $7.02. Their main revenue engine, the cloud and license business, raking in $49.23 billion, or nearly 86% of total revenue. Services account for about 9% and hardware for about 5%. Geographically, the Americas are their biggest market, bringing in $32.08 billion, with EMEA at $4.41 billion and Asia-Pacific at $1.76 billion. Oracle is a beast, and it's leaning hard into the cloud. Okay, so how does this jaw-dropping RPO translate into cold, hard cash on Oracle's bottom line, specifically for EPS? That massive $455 billion RPO, driven by cloud demand, means future revenue is practically guaranteed. For Q2 FY26, Oracle itself guided for 14 to 16% total revenue growth. But given this unprecedented backlog, we think they'll outperform that. We're projecting a solid 16% year-over-year revenue growth for Q2. Now, here's the key ingredient: operating leverage. Oracle is sinking over $35 billion into capital expenditures this year to build out its cloud infrastructure, huge fixed costs. But once that infrastructure is in place, serving new customers, especially high-volume AI clients, becomes incredibly efficient. Each new dollar of revenue contributes significantly more to profit. We estimate Oracle's operating leverage multiplier at 2.0. That means for every 1% increase in revenue, their operating income is expected to jump by 2%. So, our projected 16% revenue growth multiplied by that 2.0 operating leverage gets us to a whopping 32% increase in earnings. To put that in EPS terms, if we take their Q2 FY25 non-GAAP base EPS of about 147, a 32% jump means we're looking at an estimated 1.94 EPS. That's a significant 31-cent beat over Oracle's own guidance midpoint of 163. We ran a few scenarios. Even a minimal impact could still see a 25-cent beat. Our moderate impact, which we give a 65% probability, is that 31-cent beat. And a high impact could push it to a 36-cent beat. This isn't just good news, it's a testament to the power of cloud and AI demand. The market reacted instantly. That 20% surge in after-hours trading was driven by investors pricing in this future growth like there's no tomorrow. While the long-term prospects are undeniably strong, that kind of immediate jump does suggest the market may have overreacted in the short term, rapidly absorbing a significant portion of that future potential. So, what's the final verdict on Oracle? This is unequivocally good news for Oracle's future trajectory. Despite the slight miss on current quarter estimates, the unprecedented surge in remaining performance obligations driven by massive AI client contracts provides rock-solid visibility into future revenue and earnings growth. This makes Oracle a powerhouse in the cloud and AI infrastructure space, with momentum that simply dwarfs any minor short-term hiccups. All right, my personal take for Oracle. Given the immediate 20% jump and the market's swift pricing in of future growth, I'm leaning towards a hold for now. The long-term story is incredibly compelling, but the initial surge suggests the market got a bit ahead of itself. Wait for a potential consolidation or a slight dip before diving in, but keep it on your watch list. The underlying business strength is undeniable. And that's your ticker shock for today. If you found this insightful, hit that like button, subscribe for more deep dives, and ring the notification bell so you don't miss a beat. Remember, this is for educational purposes only and not financial advice. Always do your own research before making any investment decisions. See you next time.